Sure.
You can get started.
Yeah. Good evening, Mr. Mahadevan. My name is Pratishtha. I am the Senior Incubation Manager at IIT Madras's MedTech Incubator.
Hi, Pratishtha.
Hi. We will just wait for 2 minutes and then we will get started, sir.
Yeah, no.
Okay, we will just get started. We will let the people who are joining join as time goes. Good evening, everybody. It's really exciting to have you all for the Ask Me Anything series. For today's session, so let me give you a brief of Ask Me Anything. So Ask Me Anything series is a series that we do every Thursday, and we bring in experts from diverse sectors to answer questions that the startups are looking to get answered from the industry players. For today's session, we have Mr. Mahadevan Narayanamoni, also known as Mahad. The topic for today's session is Ask Me Anything on private equity. The way we do this session is we will have a brief introduction from Mr. Mahadevan on the topic, and then we will have questions on the chat box that you would like to ask Mr. Mahadevan, and we can take the questions one by one. We would actually encourage that the startups ask the question directly to Mr. Mahadevan. If you have any technical difficulties, then we can facilitate the question as well. We would request you to go on mute when others are speaking, and the questions can be lined up in the chat box, and we will take them one after the other. So to give you a brief introduction about our speaker this evening, we have Mr. Mahadevan Narayanamoni, the Senior Advisor, TPG Capital, co-founder, Akna Medical Private Limited, and also former advisory leader at Grant Thornton. A little more about Mr. Mahadevan. Mr. Mahadevan is a senior advisor at TPG Capital, a global private equity fund manager with over $100 billion asset under management. And he focuses on healthcare and life sciences sectors, evaluating new investments in the sector, driving value creation initiatives in the portfolio company. He's also the co-founder of Akna Medical Private Limited, Akna Med, a company set up to transform the hospital supply chain in India using technology, data procurement, and aggregation. Before TPG, prior to his experience there, he has spent over 15 years across UK, India on mergers and acquisitions, IPOs, capital raising, and performance improvements, restructuring with a focus on healthcare, pharma, logistics, and other sectors. He's also alumnus of IIT Madras and IIM Lucknow. We are really excited to have you this evening, sir. Over to you to set the tone for the session, and then we can start taking questions from the audience. Mr. Mahadevan? Sir, can you hear me? Is my voice audible? No, sir, we're not able to hear you. We're not able to hear you. Okay, sir, no problem. While we wait for Mr. Mahadevan to log in again, we have a feedback form on the chat box. So you can fill up the feedback form after the session to help us improve the upcoming Ask Me Anything sessions. Yes, sir.
Yeah, am I audible now?
Yes, sir. You are audible now.
Okay, wonderful. So sorry, I couldn't. There was some connectivity issue. So good evening, everyone. And firstly, thanks Pratishtha and Muthu for this opportunity. It's a delight to be able to participate in a session like this organized by IITM. First for me with IITM, and although I've been sort of done similar sessions on the IIM alumni network, it's great to be talking to a lot of you. Um, I think I would like to keep it as interactive as possible. Feel free to ask me anything as the sort of session agenda says. Before kind of when I open it up, a couple of minutes on a few things that I've encountered from the private equity venture capital front over the years. I've been sort of either working as a advisor or investor myself, or a board member or an operator. Any of these roles over the last 15 odd years in India, and before that in the UK, and also in the similar industry, private equity and VC industry. And I think a few things have changed and few things have remained constant over the years. And I think when I came back to India in 2006, if you said two things, one, can you raise $2, $3, $5 million of capital for a early stage business? 9 out of 10 times the answer was no, because that sort of ecosystem never existed in our country. It was not vibrant. The number of alternatives you had were far and few between. And there, to be fair, there was also a limited number of success stories for investors having invested, backed entrepreneurs and made a lot of money, right? Particularly on the early stage side. So a lot of the capital between early 2005, probably towards 2010, went towards what was growth capital, classic growth capital. So between $5 and $10 million, or going up to $20-30 million of investment across sectors, with a very strong focus on traditional consumer-oriented businesses or financial services, or hospitals and similar healthcare delivery businesses, and so on and so forth. And also on what was considered boom sectors like agri, education, and so on. But I think, success of a number of uh, sort of early stage companies during this period. Number one, number two, the entire Lehman collapse, which took a lot of sort of easy/cheap capital out of the market. Number two, number three, sort of I would say a better awareness among the sort of professional network on the kind of opportunities that existed, as well as how to look for capital and how to raise capital. Number four, a significant chunk of talent coming back to India in many, many ways, having seen some of these business models outside India, and wanting to replicate that back home. All of these kind of factors together, resulted in what I would say a fairly vibrant both startup ecosystem as well as a VC ecosystem. And I think obviously success begets success, right? And a few good exits meant more and more capital started coming behind these sort of businesses, whether they are consumer tech or otherwise. Another very interesting trend, and in some ways unfortunate. And as an investor, I feel happy, but as a operator, or as somebody who's from the Indian business ecosystem, I find it's not a great trend. Is several family businesses looking to exit, right? And the next generation not really interested in seemingly harder businesses to run, whether it's in manufacturing or hospitality or healthcare or pharmaceutical and so on and so forth. So several sort of family-run businesses coming out for sellout transactions. So ceding 40, 50, 60%, or even 100% of their equity to private equity funds, which then uses as an opportunity to build platforms. And I've obviously been a beneficiary of this trend, which is why I said it's fortunate and unfortunate. But if you just compare and contrast with an ecosystem like that of Germany, one of the sort of most vibrant sort of family business ecosystems in the whole world, and perhaps the most successful from a manufacturing business perspective, and even today one of the sort of top exporting economies in the world. They have over 3, 4, 5 generations, or 2, 3, 4 generations successfully managed to transition businesses and continue to grow and continue to be competitive. And unfortunately, we don't see enough of that happening in India. That's been a trend that's happened very fast in the last 7, 8 years. But it's again plays into the hands of private equity funds who want to buy out good quality businesses and build on top of them. So this is a interesting trend, something to watch out for. So these were some of the sort of initial comments I wanted to make, and I'll leave the floor open for any kind of conversations and questions.
Thank you, sir, for giving a really interesting start and giving a perspective on how M&A have been working and how you see them happening in the future. Any questions from the audience? Please post your questions, so you can unmute and directly ask your question. Any questions from the audience? Okay, while we wait for the questions to pour in, I'll start with a quick question. So what would be some of the quick indicators on to understand if mergers and acquisition are accretive or dilutive? Like when a startup is looking at a merger, what would be some of the quick indicators in that aspect?
Sure. So, Pratisha, when I look at this answer, can I assume that a lot of the people on the call will be more sort of startup oriented on sort of early life of entrepreneurship? Is that a fair assumption?
Yeah, that's an absolute assumption. Yes. So most of them are startups, founder team members. That's right.
Sure. So I think in that context, right, this is a very pertinent question you ask, because there are broadly three things to consider when you are in early stage of entrepreneurship. One, and the three things that define your success in the sort of medium to long term, right? One is obviously is capability. So I mean, take for example, you are doing an sort of you're a edutech entrepreneur, right? Do you as a entrepreneur, do you think your business, your team, your whatever product / solution that you've come up with, does it have the necessary capability to address the target market, the TAM, as we call it, the total addressable market? Or are there key gaps in capability that you think either you cannot build, or you don't know how to build, or there is something better out there in the market, or it will just take too long to build, right? And which you can't afford from a timing point of view. So the first thing to look at is capability. The second thing to look at is people. So are there skill sets? Are there management processes or management capabilities that are missing in your organization? Or could you accelerate growth if you were to broaden your people network? That's the sort of second consideration factor. And third is really your go-to-market / channels. Oftentimes, in early stage, you've got a great idea, you have a good team, the capability is not a problem, but you're struggling from a GTM perspective, and you don't have the right access to the right channels and so on. So look at all of these three dimensions and say, how much of these or which of these can I build organically? Which of those you don't want to build organically from a timing point of view, or capital point of view, or capability point of view, and therefore look at either partnering, merging a couple of companies, or so on and so forth. And obviously, a lot depends on capital availability, right? Are you backed by either HNI, angel, or VC capital to help you drive this? Or if you're finding it difficult to raise capital, can you get together with one or two other similar companies in a similar platform to plug these gaps and sort of be more attractive to raise capital? So I think those are the three dimensions on which you should think at that stage. And of course, an important consideration here always for an entrepreneur is dilution, right? In doing all of this, post doing all of this, is will I still hold a meaningful equity in the company? Number one, and number two, and I will be naturally more diluted, but at that diluted level, have I significantly increased the value of the company or increased the chances of success of my company by going through this process? So these are some factors, and there's enough examples of this in the market, right? I'm starting with Myntra, Flipkart at a fairly large scale, and there are several others of smaller scale which have done this at a very early stage in their life cycle to address one or two of the dimensions I talked about.
We're still waiting for questions from the audience. Audience requesting you to kindly post your questions in the chat box, or you guys can also unmute and ask the question. directly to Mr. Mahadevan. So while we wait, another follow-up question on the first question: would you be able to share some examples of some of the mergers and acquisitions that have actually succeeded, and some of them that have failed, and what could be the possible reason for success or failure?
Okay, now this is
This is a loaded question, I know, but
yeah, yeah. So, and I think I would like to sort of, I think it's a the issue with some of this is not everything is in public domain. Some things are, some things are not.
yeah, no, whatever is in that
Yeah.
you're comfortable
So
answering.
sure. So I mean, if you take and let's firstly define success, right? I think the way when you go about doing M&A, there are 2-3 things that you sort of that would define success for you typically. First, those 3 dimensions, like I mentioned, are you checking those boxes? Number one. Number two, if there might be financial drivers behind it, the desire might be to build scale quicker. Number two. Number three, the desire may be to the success factor objective may be to exit to one of your investors. That may be driving this decision, right? So it could be any of these factors. So therefore, what you define as success, will can obviously tell you whether a deal was successful or not. Let's take and all of this is complete individual perspectives, right? And let's take a couple of examples which may be familiar to people. You take Flipkart and Myntra as one, right? Or you take Walmart and Flipkart as a follow-on. Now there would have been, and clearly both of these were driven by a combination of investors' desire to create value for themselves and build scale, or the desire of the founders and the management team to create something of significance to compete with Amazon as a competitor in the market, right? So I think if you keep these as the objectives with which they went into it, you have to admit both were successful transactions in that. Through the Flipkart Myntra merger, you were able to take out a meaningful competitor. Number one. Number two, you were able to add capability in apparel where Myntra had significant depth. Number three, you were able to significantly reduce operating costs by removing duplicate logistics, warehousing, technology costs, all of that. And number four, you were able to build greater buying capability, which will help negotiate better with some of your private label vendors and so on, right? So there's a bunch of things that would have gone into it from a business point of view before they did a transaction of that nature, even if the key driver may have been common investors across both the companies and desire to exit and create value. So from if you look at it from that point of view, I would say it was a successful transaction, right? But now let's look at the same transaction from a financial metric point of view, right? So the reality is, after so many years, still the businesses individually and on a combined basis are loss making, and we all know with the kind of money that's getting spent on e-commerce, how long it might still take to for this to hit profitability. So purely, if you were to say as a does the financial stack up at the end of all this? It's subject to. I mean, it's a matter of opinion, and it depends on how things play out over the next 2-3 years, right? But purely from a investor rationale, business rationale, and synergy ability to take out a competitor, it was a successful deal, right? I think the point I'm trying to make is a success or failure of a particular transaction can be, it depends entirely on who you talk to. You talk to some of the key employees, are they happy about it? Because ultimately an M&A is not just for investors and shareholders, right? It's also for all the other shareholders, all the other stakeholders in the ecosystem. Are they equally happy? Did they create value out of it? So you look at all of these factors and come to a conclusion. You look at something like Naspers and Redbus, right? That's another transaction in a similar space that happened. Had a certain vision on how things would pan out when that was done, but purely from a numbers path to profitability, all of these perspectives, keeping even the impact of COVID aside, it's not played out the way it was expected to play out, right? And a couple of interesting transactions to watch out would be the acquisitions that Byju's has made in the recent past, in the last couple of months, and frothy valuations, huge capital outlay, cash out of the company. Will that really drive value, and is it being driven because there is quote unquote cheap capital available that needs to be deployed, or is it truly driven by business synergies? And even if it is driven by business synergies, is it being valued appropriately? So I think ultimately, once you bring valuation that is being paid and the returns on it into perspective, I can fairly say over the last 15 years, I've probably worked on upwards of 300 transactions across sectors, across countries. I can safely say that a minimum of 50% of the M&As are failures. A minimum. The minute you bring in money that is paid out and the returns that it was expected to deliver, bring that into focus, a minimum 50% will be failure.
Yeah, that's beautifully answered. I think a lot of takeaways from that thing. See, both the parties have to be ready. The pre-merger acquisition phase, where they actually have to create that infrastructure in both the companies, is very important. And then the organization to be able to transit and the employees being able to take it, plus the valuation, how is it done? So even technology companies saw a great hike and then a dip in the recent past, where we saw Tesla spiking up and then dropping, and the valuation was really speculating. So that's very beautifully answered. Thank you, sir. We have a question from Archana. Archana, do you want to go ahead and ask a question?
Thank you, Pratishta. Hello, sir. My question is, what is the difference in the private equity and in venture capital, sir?
Yeah, so it's a technical difference, Archana. So usually it's defined by stage of a company in which the investment happens, and the quantum largely. So venture capitalists are expected to take some level of venture risk, right? So in the sense that not everything about the business is played out, so there might be still venture risks. So to give you an example, if it's a health tech business, it may which you've launched, your product is defined, you've started generating revenues, but your path to profitability may not yet be clear, or you might be a one state wonder. The ability to scale nationally may not be clear, or your ability to scale internationally may not be clear. So it could be any of those. But there is a meaningful amount of venture risk that they take when they invest, and that is typically why they call venture capitalists. And typically, in that scenario, you expect a greater return on your investment, because you expect greater number of failures. If you make 10 investments, you expect there is a reasonable number of failures, and therefore the returns from the ones that succeed need to pay for the ones that fail. So the return expectations of VCs therefore are higher. Private equity funds are typically, they come in usually when a business model is clearly defined. There is a clear growth path. The company is already operating to some level of stable unit economics, and you're coming in to effectively scale up that business to a higher level, and the risk factors associated with that are lesser, right? And usually, and you all know this, 0 to 1 survival rates and risks from 0 to 100 and 100 to 1,000 and 1,000 and beyond. Each of those levels are very different. So I think that's the kind of key difference between VCs and PEs. And naturally, the return expectations and what they generate typically also as PE funds tends to be lower than VCs on a successful deal.
Thank you. I think that's answered Archana's question. We have a question from Mr. Errol Krishnan. Mr. Errol Krishnan, do you want to go ahead and ask your question?
Yeah, I would like to do that. Yeah, good evening, Mr. Mahadevan, sir. My question is, do you feel that private equity has huge scope in India during the pandemic, especially on the care companies, compared to the investment banking or the venture capitalists?
Yeah. So again, I think good evening, everyone. So firstly, investment banking and venture capitalists are I would say not comparable. So I would compare VCs and PEs in the same bucket. And I would just answer to say investment opportunity in the healthcare companies during the pandemic, right? I think that's the sort of, look at it in that point of view. Um, Definitely, if you see the last 6 months, a lot of the capital that has gone in has gone behind edutech, because what people think are likely to be structural shifts happening in the education industry because of this, and awareness or slash steps taken by people in a post-COVID scenario, and also health tech companies. So any company which is sort of bringing technology to play to deliver healthcare differently. Definitely, both have attracted significant interest during the pandemic, and I think that would continue to be the case even in the future. So it could be telemedicine, it could be e-pharmacies, it could be e-diagnostics, it could be home delivery slash home collections of tests, and so on and so forth. And remote management of healthcare facilities. All of those kind of companies have attracted good amount of interest over the last few months, and I think they'll continue to do so. Unfortunately, there haven't been, but for a few reasonably scaled companies already, there haven't been too many companies with meaningful scale which have been operating for 2-3 years in the space to attract serious capital, but it is definitely happening. On traditional healthcare companies, and if you see, if I include life sciences and pharma within healthcare, I'm sure if you keep track of what's happening on the stock market, that's pharma has been one of the most sought after player space in this market, in this space, because of number of factors. One, consumption of a whole bunch of types of medicines have gone up during this period, and not just your specialized medicines for COVID, but also for general pain management, respiratory relief, supplements, and all sorts of medicines have been consumed, are being prescribed and consumed a lot more than historically. So that's all of the pharma companies which are playing in those kinds of portfolios have benefited. Number one. And number two, for companies which are focused on exports have benefited a lot, purely because several parts of the world are uncomfortable relying on China as the main source of supply, and that's kind of benefited India as the second largest manufacturer of several pharma products, and at a equally, if not better quality at similar prices. So that's again been a major factor for benefit. So that's as far as pharma is concerned. Now, the one sector which is struggling or struggling to cope with it in very many ways, and not really attracted much investor interest, is the healthcare delivery space, which is your traditional hospitals and so on, because nobody knows exactly how things are going to stabilize, and when things are going to stabilize more than anything else. Right? Everybody knows that hospitals are a necessity and they are recession proof and all that good stuff, but the reality is the volumes of typical non-corona volumes in hospitals are significantly lower than what they have been in the past, and people are being cautious. Is it going to correct itself in 3 months, 6 months, 9 months? We don't know. So not able to decide on what is the right value for a particular hospital or particular healthcare chain. So those companies have been impacted, not as much interest as there has been in the past. But otherwise, several other parts of healthcare value chain has been favorably looked upon by investors.
I would like to ask us another question, second question. Why PE fund invest in mature business? They do not invest in early stage or the startup companies.
Yeah, so like I said, there are both two types of funds, right? Venture capitalists and PE funds. The investors who ultimately it is similar pool of capital. There are people who want to invest in private companies and sort of back them for growth and make returns out of that. The ones that there are, I mean, like I said, over the last 5-7 years in particular, the number of companies who are interested in investing in early stage has mushroomed significantly, and that's why you have an amount of VC deals that have been happening. Private equity funds, by definition, are not expected to invest in early stage companies. They are expected to invest in companies which are mature and which are looking for the next phase of growth, either through M&A or either through international expansion or by launching new product categories and so on. That is the objective with which a PE fund is set up. Whereas a VC fund, like I said, is set up with the objective of investing in early stage companies, and they are the guys who tend to do that. And there are several of those who do right from seed funds kind of investors who invest $400,000-$500,000, 2-3 crore rupees, all the way to sort of very established VCs like SAF partners in Square and so on and so forth, who invest up to 150, 200 crores in the company.
Thank you so much, sir. Thank you.
Sumitra has a question. Sumitra, please ask your question.
Okay, yes, Pratisha. So my question, sir, how many major equity firm are there and what they look for, sir?
Sure. So there are, well, if you look at the number of registered venture capital funds in the country, there are, well over a couple of hundred of them, venture capital / private equity funds in the country, well over 200 firms in the country. I would say at any point in time, there are at least 100 active funds. When it's active, they're actively looking to invest and do deals, at least 100, maybe more. And this number has only been increasing and not decreasing. What they look for, no, that is literally the $1 million question, right? In many ways. So, and if you see, let's talk about a VC, since a lot of you are early stage entrepreneurs. What a VC is looking for is to say, ultimately they are interested in investing and making money, right? So that's the fundamental thesis behind this, to say, if I invest 10 rupees in a company, how am I going to make my 4x or 5x in X amount of time? So that's the basic going in requirement, and everything that they do, all the questions they ask is based is to get comfort around that. So a few important factors. Firstly, what is the market opportunity? Is it large enough? Or is the business targeting a very small market opportunity, right? I think that's probably the single biggest question that VCs ask when they're looking at a particular business. Because if you might be a fantastic business with a great team with great profitability, but if they believe that the market opportunity is very small, or the Indian market is not ready for it, or there is or whatever, they just will not invest in it. So that first and foremost is the potential size of the market opportunity, and usually that will need to be in thousands of crores for it to be attractive for any VC, because very few people will want to underwrite to a investment where they'll say, I'll back a company which will gain 70-80% market share in a small market. They would rather underwrite to a good team and a good idea being implemented in a market where they can gain 10-15% share in a large market and become successful. So I think that's the first question they look at. The second thing is the quality of the team, to say, okay, this is a great market to go after. So take, for example, e-pharmacy, right? As an example, e-pharmacy is a great market. The overall pharmacy market is several $1 billion. And within that, even if the e-pharmacy is only 15% or 10% of it, it is still worth multi-billion dollars as a market. So it's an attractive market to go after. Given that it's an attractive market to go after, what is the team that I'm talking to? How good are they? When I say how good are they passionate, committed to this? Are they in this for the long run? Do they have the tenacity to deal with ups and downs in a business, which naturally will be there? Is there a full set of skill sets required to capitalize on this opportunity, or is it are there gaps, like are there technology gaps, or are there marketing gaps, and so on and so forth? And how well does that team stick together and work together, right? I think that's the second biggest factor that they look at. And usually, what a lot of VCs do is, if the market opportunity is great and the team is fantastic, that checks a lot of, that takes care of a lot of their internal requirements. And the third one is, has the team come up with a scalable business model to capitalize on this market opportunity, right? So the market opportunity is great, the team is good, but have they figured out a decent business model to capitalize on this market or market opportunity? I think that's the third. So taking the e-pharmacy example, has the team come up with a model where they can reach out to enough number of patients, they can get them to buy medicines online, they can get the prescriptions validated online, and doing all of that, they can make a margin on that transaction, right? Even if they cannot make a net profit on the transaction, are they able to make a margin on every transaction, so that they know you can get comfortable that going forward, as you scale the business, this will be a profitable venture. So these are, I would say, obviously tons of other questions on scalability, how much capital is required to scale, who will buy this business ultimately, or will this get IPO'd, or are there other mergers that can be done, etc., etc. But the three cornerstone questions are TAM, nature, size of the market opportunity, 2, the quality of the team, and 3, Is there a validated business model that we can back? And then, of course, they take. Then they would be willing to take all the other risks of scaling, of regulatory issues, of valuation, of capital requirement. All of those risks they'll be willing to take typically once these three are ticked.
Thank you, sir.
Thank you. We have a question from Mr. Deepak. Deepak, please go ahead and ask your question.
Hello. Hi. Good afternoon, Mr. Mahadevan. If the question was that if one is a lone force behind an edutech venture, for example, is it better to get an investment and hire a top-end core team to do all the complementary stuff at the top level, or would it be more advisable to identify complementary ventures that one can merge or partner with? Are there successful examples or failed examples in both these situations that you could share at a younger startup level?
Sure, Deepak. It's interesting you asked this question because it is not different for edtech necessarily as a sector, and I have a very personal example, a dear friend going through this at this point in time, and I can also talk about my own example of a venture that I've co-founded. Firstly, when you're looking at, like I said, right, the TAM, business model, and team, all three are the three cornerstone thesis when you're looking at an investment from anybody, or when you're looking to scale a business, whether you're looking to invest to raise money or not. In doing that, a broader team gives you a number of things, right? It gives you ability to do more with your time. You don't end up getting dragged into every corner. So notwithstanding the sector, notwithstanding whether you're looking to raise capital or not, and considering the fact that it is scaling a business is not an easy thing, but in general, I would 9 out of 10 times I would advise entrepreneurs to consider having co-founders and a broader team than trying to go it on by themselves, right? So irrespective of the structure. Now, once having decided to not go alone, and by the way, let me also tell you that you might say that I'm okay to pay reasonable salaries and onboard a employee or a set of key employees and give them options and so on and so forth. The success rate of something like that is generally less in a very early stage, right? Because it's hard to get people that you just hire to think the way you think, take the same level of risk, stretch themselves to the point that you're willing to stretch, and be creative on a number of fronts, which is all required in the early stage of a company. So in general, irrespective of the sector, like I said, just on hiring people with some options and with some salary at the very early stage of a business and expecting them to complete the skill set and the capability set and work with you as entrepreneurs is very, very difficult. It's not something easy to do. Having said that, I've personally gone through an example with this, like I said, for a friend of mine who's been trying to, he's in the sort of on e-fitness space right now. He's building a business in that space, and he's been desperately looking out to onboard a co-founder who comes with a technology background. This guy, while he's got a technology background, he needs to focus on go-to-market and customer relationships and consumer outreach, and he wants somebody to take care of technology. And he's been finding it really difficult. Either somebody comes and says, give me 20-30% of the company, and I'll not put in any money, and so on and so forth. Or somebody comes and says, I want X amount of salary on day one. I'm not willing to take that kind of a risk. Or if it's a third category, which is not asking for either, you really have to wonder, is that person, what is the motivation behind that person coming on board with you? So he's going through that struggle right now. And I think, if the option exists of getting together with, and he's also looking at that option, getting together with another company which is more technology oriented but doesn't have the same level of marketing outreach or business acumen that he has, he'll be more than happy to merge, because on your own, holding 100% of a company, not really going anywhere, is far worse than owning half the company, being on board with somebody else who completes a skill set and gives you the capability that you need to scale your company, right? So I would say, if the option exists of merging with like-minded people, and who you have sort of some level of trust and understanding over, that is an option definitely worth considering. Because chances are that if you don't have those capabilities plugged, you will not even get the investment that you're talking about in the first place to be able to hire people and spend money on hiring people. So I think, I don't know if it's a slightly long-winded answer to your question, but I think that's the direction.
Yeah.
And I think, the sort of safe harbor here is that um, getting together with completely unknown people who you're meeting for the first time, had met over 2-3 cups of coffee and spent 7-8 hours, 8-10 hours talking, and then bringing them on board, the probability of success is less than 50-50, less than 50%, right? So that's something to be mindful about. Often the success lies in getting together with somebody that you've known for a number of years, so that at least the personal trust and integrity and all of those factors are taken care. So if you just completely out of the blue onboard somebody, the probability of success is, I would say, 50% at best.
Yeah. Thank you so much. Thank you. That was a wonderful answer for me. Thank you.
Thank you, Deepak.
Thank you. We have a question from Muthu Krishnan, but I don't clearly understand it. His question is, what is your opinion on where does the economy motivate? Muthu Krishnan, do you want to elaborate on that?
Yes, sure. At first, let me assume that there are two types of organizations. Like one is like manufacturers, they produce devices, and another type is that they will be providing some. They may be service providers, like e-trading or online educational services, like that. So, as an advisor, where do you think our economy should focus on? Is it like product based startup, or is it like a service oriented startup?
So, Muthukrishnan, so that I think um, it's an interesting question. Firstly, when you say economy should focus on, economy comprises people like you and me, right? So we are the economy in very many ways. So if you just take the entrepreneurship world aside, I'll come to that. That's probably the most critical part in many ways. Then you have the government and regulators, and you have enablers like financial institutions and stock markets and so on and so forth, right? So three players within the economy. And obviously the workforce, which is people who work for all the organizations, are common across all of these. But take the entrepreneurs category and say who we should be focusing on, or where we should be focusing on. As an entrepreneur, you're always focusing on where the opportunity is to build a business and make money, right? In some ways, in a very crude way, I don't care if I'm making it out of manufacturing or service or trading or technology or whatever. If I'm interested in building a business to create value for myself and for my family, and also for my other stakeholders like employees and shareholders, if it comes through trading, great. That's what I'll do. I don't care if so much whether it is manufacturing or not, right? In some ways, the key question to ask is, as regulators, as government, where should the focus be? And while there is a lot of talk around Make in India and self-reliance and all of that good stuff, is that focus really translating to action? And you talked about medical device as an example, and if I can tell you from personal experience, in that particular field, more than any other, I think, in that particular field, starting out on day one with manufacturing, you are looking at a minimum 4-5 year journey before you start seeing any kind of meaningful revenues. And even then, you're looking at a significant barriers to entry, depending on where you are in the sort of innovation spectrum, or where you are in the are you in surgical, are you in medical, or are you in critical care, or where you are. So for the sector that you asked, if you ask me, I want to get into medical devices, I want to do something in devices, should I start with manufacturing or trading? I would strongly urge you to look at trading / marketing in the first instance. Establish your brand, your customer relationships, and develop a good understanding of the market. And in parallel, continue doing backward integrating those products or developing other products from a manufacturing perspective. Or otherwise, just be prepared for a fairly long haul from getting the product designed, then it prototyped, then manufactured, then manufacturing license, then DCGI approval to sell the product, getting trials done if depending on the nature of the equipment you're talking about, and then ultimately after all this, getting your CE mark or FDA registration or whatever it is, and then convincing customer. It's a fairly long haul. So considering that, in that specific subsegment, I would ask you to always, have one eye on manufacturing, but not ignore the opportunity that trading or marketing presents.
Thank you. We have a question from Ranjit. Regit, can you go ahead and ask your questions? You have 2 questions, I see.
Yeah. Firstly, during the seed funding round, should we discuss about our potential mergers and acquisition? And second is regarding share pattern amongst the co-founders. Is there a relevance in being equal or it's too much squared? And what is the current status of vested shares in India?
Sure. So I may have to get some clarification on your third question, but I'll answer the first 2 first. So seed funding, I'm presuming you're talking about really the first external capital that you'll raise in your company, right? Yeah. So, and when you say merger acquisition, you're talking about buying a business with that money, or you're talking about, like Deepak, a couple of other people asked, combining yourself with somebody else?
Combining.
Yeah. So if you're looking at combining yourself with somebody else, as long as that is being done for the right reason. So, for example, you're saying, like I said, there are capability gaps or skill gaps or go-to-market gaps that you're going to plug by combining. If you think and if you're convinced that you can get that point across confidently to investors, it is always better to be upfront. Because as a seed investor, if you ask me, I invest X amount of money in your company, and then suddenly, 2 months after investing, you say, hey, I'm going to merge my business with another business because it is important. I will actually, probably feel, that things were misrepresented to me, right? And I would rather have that information ahead of time because it will help me make the decision to say, I am investing in a broader team and broader capability. So if it is imminent, like if it's going to happen in the matter of the next 1, 2, 3, 4 months, and if you've made up your mind, it is always better to be transparent with investors, incoming investors, and be upfront. That will be my advice on that. Your second question on inter se shareholding across founders, there is no right or wrong answer here, but in general, the things that define shareholding are, one, who took the risk, right? The person who took the maximum amount of risk or the earliest risk always gets a disproportionate amount of shareholding, right? So if you started the venture today and you spent 3 months running around burning 6 months, 1 year, whatever it is, and then your next guy came on board and the next guy came on board, definitely your shareholding needs to reflect the fact that you took risk earlier than them. Number 1. Number 2 is capital. Particularly, in the early stage of risk, that's again reflected in risk, right? You took risk not just by coming in early and quitting something and starting something earlier than the others. You also put in more money than the others did. So that also should reflect in the cap table. And third is capability in some ways, and that's the hardest. And that's the one where I found founders tend to fight amongst each other to say, hey, fine, you came in early, fine, you put in more money, but I'm as capable as you. Why should you get more for capability? So, and that's something that you'll have to resolve on a case-to-case basis. But definitely, risk and capital put in and time of coming on board are major factors in determining inter se shareholding.
I was asking about the vested share, like You give some 50% first year, then 25% next year. That sort of shares. Is it possible in Indian scenario?
Yeah, it is possible, and just have to be careful about making the appropriate filings with ROC, as well as being being able to deal with the tax consequences of doing that. But it is possible.
Okay. Thank you. Thank you very much.
Thank you. Our next question is from Mr. Stewart Gratian. Please go ahead and ask your question. Stewart, are you there? I think he's not there. Let me ask the question on his behalf. So he says, I'm an early stage medtech innovator who has a government grant and is in the process of finding a co-founder and registering a startup soon. In my discussions already, an incubator has asked for 10% equity. How much dilution of equity is advisable in such an early stage when startups are formed? Or should I think about such large dilution of equity only when the product is near to market? Also, please advise on sharing of equity with co-founders.
Sure. Stuart, firstly, if you are able to, there are two reasons why you bring on board an investor in the company, right? Very early. One, you don't have the money to put in yourself, or you don't want to risk so much of the capital yourself, which is completely fair game. Or even if you have the money, you think the incubator or the accelerator or whatever you're talking about is able to add some value, either through connections or helping you get grants or helping you hire people or helping you reach out to a few customers faster and better than you would be able to do on your own. So these are two reasons why you would try to raise capital early in the game. And I think from various perspectives, 10%. Again, I don't know the specifics of your product or the incubator, but 10% doesn't seem like an unreasonable ask, if you ask me, from any incubator for an early stage investment if they're coming in. Again, depends on quantum. Are they talking about 2 lakhs, 5 lakhs, 10 lakhs, 1 crore? It all depends. But in general, if you think they are going to cover at least a meaningful part of your sort of prototyping / sort of fine-tuning, sort of a product development journey, then I think that's what you need to be looking at, right? What will the money that for the 10%, what will it give you? Is it going to buy you 2 months time, 3 months time, 1 year's time, 2 years time for the business? If it's going to give you anything more than 9 to 12 months time, or 12 between 9, 12 months and 18 months time, depending on the nature of your business, it doesn't seem unreasonable from an ask point of view. And your second part of your question was around co-founders, right? How do you share equity with co-founders? I think I sort of answered that question with what Rajit was asking. Is basically, and it depends entirely on your confidence, your need. If you think your business can't go to the next level without, and for example, if you're a technology guy, you think you need somebody who understands the medical devices, marketing and commercial side well enough, then you have to think about what motivates that individual and what you think will drive that individual to think and behave like an entrepreneur. There is no science to this. People have got away with, and I know a business where somebody has got away with giving as little as 10% to a co-founder who came right on day one. On one of the businesses I incubated, which is Akna Medical, me and another two of us started it together. We diluted to the extent of 30% to co-founders. A couple of co-founders who came on board. So it depends on the specifics and the nature of the capability the individual brings to you.
I think that's answered Stuart's question. We have one more question from Mr. Errol Krishnan on the guidelines for investors. Please go ahead and ask your question, Mr. Errol Krishnan.
Yeah. My quick question will be, what are the guidelines to be followed by investors who choose to invest in private equity of a company so that the share profits are at the maximum?
Sorry, I didn't. get your question.
So what are the guidelines that the investor should follow who can choose to invest in a private equity of a company, sir?
Okay, I think, again, it is I think you're asking from a commercial point of view, not from a regulatory point of view. It's again,
Yeah,
something I'd sort of go back to what I sort of mentioned right at the outset. They are looking for, when they look at the company, looking at what space has the company operated, how big is that market, is the business model mature, is that a defensible business model, has it started proving out, or are there still doubts around whether there is a business model that's that's revenue generating / profit generating, and third, how good is the team that's driving this business. I think these are the three things that one would look at before even deciding whether to invest in a company. And once you decide based on these factors that okay, this is an investment worth making, then you look at how to value the company, and that depends. And again, I'll go back to if the financials, financial track record over the last few years, if they exist, and in several startups they don't exist, then it is a question of how big a market, how big a share of the market the startup can reasonably be expected to get. And based on that, if I invest $500,000 or $1 million or $5 million, whatever it is I invest in the company, when I ultimately look to exit 4, 5, 6 years down the line, at what valuation, if I enter, would I get my 4x, 5x, 6x, whatever is my return that I expect as a venture capital. So I think that's how they look at it. I mean, I think beyond that, to look at how to value a company, that's, I would say, several hours conversation by itself, if not several days. So
yeah. Thank you so much for the clarity, sir. Thank you.
Thank you. We have one, I think we'll take one last question from Sindhu. Sindhu, please go ahead and ask your question.
So, good evening, sir. What is the equity interest role after the investment?
right. So it is usually, Sindhu, I mean, it is what you want the investor to be. There are, I have been on both sides as an investor and also as an entrepreneur who's got investment. It is, it could be as little as just sort of providing governance, bringing focus to you as an entrepreneur. You promised these 5 things when I invested. Are you sticking to those? Are you deviating from those? Just helping you sort of remain focused on your journey. Number 1. Number 2, ensuring that you follow the right governance standards, whether it is financial reporting, whether it is how you handle employees, whether how you deal with compliances, and helping you with that. That could be at the board, mostly at the board level. Number 2. Number 3, just acting as a sounding board for you to bounce off things on, I want to course correct on my strategy, or I want to enter a new product category, or I want to make a senior hire, I want to create an ESOP pool. It could be any of these kinds of business decisions. They can act as a sounding board. I think these are, I would say, the minimum that you would expect any investor coming in to play. Beyond that, it varies a lot based on entrepreneurs' need as well as the type of investor they're talking to. But these are, I would say, 3 bare minimums that you would expect any investor bringing in equity to play.
Oh, okay, sir. Thank you.
And so then one very, very quick word of caution. Be very careful about taking capital from investors who promise that I'll help you grow the market and I'll do X, Y, and Z, because it is your business and not the investor's business.
Thank you so much. I think that was that was very, very helpful. So with that, I think we are almost at 6. We will wrap the session. Thank you so much, Mr. Mahadevan, for your insights. It was wonderful. You've been very patient and very comprehensively answered all the questions of the participants. We look forward to having more sessions with you in the future. So as a practice, we usually upload the recorded version of the video on our YouTube channel. Requesting your permission to upload the video, sir.
Sure, no problem. Although I don't think there was a video, right? It was only audio, so that's fine.
Okay, yeah. I mean, the recorded version of the clip.
Sure. Yeah, please, no problem.
Okay. Thank you, sir, and thank you everybody for joining us this evening. We have a feedback link form on the chat box. Please fill up the form and help us improve the upcoming sessions. Thank you, Mr. Mahadevan, for joining us this evening. Thank you, everybody.
Thank you. Thanks, Muthu. Thanks, Pratishtha.
Thank you.